In the previous video on mastering your mental state to master the market, we talked about how a trader's greatest edge isn't his system or his setup. It's his own psychology. Today, I want to build on that foundation. How to build a position with the mindset of a consistent trader. Because make no mistake, trading isn't about being right once. It's about creating an environment where being right is simply the natural outcome of doing the right things repeatedly. Now, let's make something clear from the start. Building a position isn't about predicting or forcing your view onto the market. That's what emotional traders do when they get caught up in excitement or fear of missing out. Professionals don't react. They observe, they align, and they act only when the market provides evidence. Think of it like tuning in to the market's frequency before making a move. Have you ever noticed how the best trades seem to unfold gradually, almost naturally? Not in one dramatic burst. That's because real consistency comes from building into probability, not into emotion. When I enter a trade, I never go all in. Never. The first position is just a test, a way to see if the market's energy is in sync with my belief. The market doesn't make mistakes. Only traders do when they interpret it through their fears or desires. If my initial entry behaves as expected, showing clarity, balance, and momentum in my direction, I add, carefully, methodically, with the calmness of someone who understands that trading is a process, but if it doesn't, I'm out. Quick, objective, and without resistance. You see, the consistent trader treats capital as emotional capital first. You don't waste it reacting to every impulse. The amateur trades from the need to avoid missing out. They're driven by the illusion that opportunity will vanish. But let me ask, what's more damaging, missing one trade or emotionally collapsing in a bad one? You can always find another setup, but you can't trade effectively when your confidence and clarity are drained. Professionals know this. They don't chase the market. They synchronize with it. They build their positions slowly, adding only when the market keeps confirming alignment. This is where discipline transforms from a rule into a belief system. Discipline isn't just cutting losses. It's about staying patient when the ego wants to act. Most traders can't do that. They crave stimulation. They confuse activity with progress. But trading, true trading, is about waiting for the market to communicate clearly before committing more risk. You wait for confirmation. Then you engage one calculated step at a time. Never too heavy, never too attached. I've seen many traders gain big in bull markets and lose it all when the market shifted. Not because they lacked intelligence, but because they built positions from fear and attachment, not from probability. They averaged down, not up. They thought they were improving their odds, but really, they were trying to prove they were right. The market doesn't reward the need to be right. It rewards those aligned with truth, and truth is always found in price. Averaging down is just another form of denial. Hope is resistance to what the market is communicating. Would you keep betting on a losing hand at the poker table just because you want it to win? Of course not. Then why do it in trading? Building a position correctly means reinforcing your alignment only when the market confirms it. When a move unfolds smoothly and the data supports your bias, that's your green light to scale. But do it with awareness. Let each layer of size earn its place. You're not trying to catch perfection. You're participating where the odds favor you most. That's the zone where consistency lives. Remember, in that last discussion, we talked about emotional neutrality? This is where it pays off. Building a position properly demands complete psychological balance. The market will tempt you to act too soon or too aggressively. But your job isn't to control the market. It's to control your perception of it. The emotionally stable trader waits for the market's feedback before committing. That's the trader who survives. Every consistent trade I've ever taken had one thing in common. The market confirmed it before I did. I didn't try to impose certainty. I responded to clarity. That's the essence of flow. Never fight the tape. If it moves in harmony with your plan, you engage a little more. If it diverges, you step aside. Simple, but psychologically difficult. Most traders can't stand uncertainty, even momentarily. They personalize loss. But trading isn't personal. It's a mirror. The market reflects your ability to remain objective under stress. When building a position, think like a strategist managing risk, not a gambler chasing validation. You don't send all your troops into uncertainty. You test, you observe, you adjust. If the terrain supports you, you commit more. If not, you pull back. Trading is a dialogue between your mind and the market, and your ego is the only real enemy. Price movement is your feedback loop. News, forecasts, opinions, they're distractions. The market speaks through its behavior. If your first small position begins to work, that's the market saying, you're in sync. Add a little. If it continues to reward your discipline, add again. But when it falters, stop. Professional traders know that restraint is just as powerful as action. Most traders want to win big immediately. They want emotional validation, not consistency. But consistency is built from many small, correct decisions, each one grounded in non-attachment. The difference between a gambler and a professional is mindset. A gambler trades to feel right. A professional trades to stay aligned with what is right. And understand this. It's not about greed. It's about process. The market rewards structure, not emotion. When you build a position through confirmation, you protect your confidence even when you're wrong. That's the invisible edge. A professional trader doesn't aim to be right all the time. He aims to manage his perception so that when probability aligns, he's ready to maximize it. Wealth in trading doesn't come from a single win. It comes from the compounding of disciplined responses to the market's signals. Every trade is feedback. It refines your self-awareness, your patience, and your emotional control. When you build correctly, you're training your mind to act from belief, not fear. That internal conditioning, more than any pattern or indicator, is what creates lasting success. So before you enter your next trade, ask yourself, am I acting from evidence or emotion? From alignment or attachment? Answer that truthfully, and you will already be ahead of the majority who act impulsively. Because building a position like a professional isn't a strategy. It's a mindset. It's the capacity to wait, to confirm, to trust the process, and to remain emotionally neutral when uncertainty reigns. Few traders can do that, but those who can are the ones who rise above randomness and find consistency. Be the trader who flows with the market, not the one fighting it. Build only when confirmation comes, because that one principle carries more truth than any system ever created. Most traders try to impose their will. Professionals allow the market to confirm theirs. The market doesn't care about your ego, your conviction, or your story. The only truth is price, and the only skill is interpreting it without bias. When I take a trade, I don't assume I'm right. I assume I'm participating in a probabilistic event, and the market will immediately show me whether my belief aligns with reality. That first entry is small, deliberate, not to make money, but to test alignment. If the flow continues, that's confirmation. If it hesitates, I disengage. Think of every trade as a dialogue with the market. Your entry is your statement. Price is the reply. If the reply supports you, you continue. If not, you step back. Never argue, just listen. The market always speaks first. Confirmation appears in behavior. Strength holding after breakout, smooth volume expansion, or rejection where expected. Learn to interpret this feedback. Charts are emotional landscapes, the footprints of belief and fear unfolding in real time. When collective conviction moves, you'll see it. And that's when the consistent trader builds. That's when you start to build. But never before. Have you noticed how the best moves in the market almost seem to invite you in? The price flows smoothly. Every brief pullback is met with renewed momentum, and everything feels aligned. That's confirmation in motion. The market communicating. You're in sync with the collective. Belief, but stay conscious. The worst moves, on the other hand, always feel uncertain. The price hesitates, oscillates, and lacks conviction. You can feel the indecision in the chart. That's the market whispering, something's off. The consistent trader listens. The emotional trader ignores. Here's the subtle truth. Confirmation doesn't mean certainty. It doesn't mean you'll catch every move at the absolute start or exit at the perfect peak. It means you've aligned yourself with probability, not prediction. You're responding to what is, not what you want to be. Most traders don't lose because they're completely wrong. They lose because they act too soon. They enter before the market confirms consensus. They buy because a stock looks cheap, forgetting that value is meaningless without demand. They sell short because a price looks high, forgetting that momentum can push higher than logic allows. Only price, clear, undeniable price, separates a valid opportunity from an emotional assumption. And remember what we discussed earlier about mastering emotional balance. This principle connects directly to it. Waiting for confirmation requires the ability to detach from the need for control. It takes patience to sit still as the market moves without you, to resist the urge to chase, and to maintain your composure while others act impulsively. That restraint isn't luck, it's awareness. Timing emerges naturally from clarity, not from anticipation. When you begin trading this way, your perception changes. You stop needing to predict outcomes. You become an interpreter of energy flow, a follower of momentum, not a forecaster of reversals. You stop needing to be right and start aiming to be aligned. The market rewards alignment, not ego. Your entries become smoother, your drawdowns shallower, and your confidence steadier. Not because you suddenly know more, but because you're finally listening without bias. There's something freeing about acting only when the market confirms your belief. You stop fearing missed opportunities because you know there will always be another. You stop identifying with opinions and start identifying with feedback. You no longer need to prove anything. You just need to observe. The market will always tell you when it's ready to move. Your role is simply to wait for the invitation. That's why professionals spend hours in observation, not searching for perfection, but cultivating patience. Their advantage isn't hidden knowledge, it's psychological control. Here's the core truth. Confirmation is participation. When confirmation appears, it signals that belief has spread. Institutions, funds, collective sentiment, all are flowing in the same direction. You're not resisting that current, you're joining it. That's where safety and probability merge. Acting without confirmation, on the other hand, means stepping in before consensus is formed. That's why those trades feel lonely, uncertain, and emotionally charged. You're trading against the collective flow instead of with it. So before your next trade, ask yourself, has the market confirmed my perception? Has price action proven that my idea aligns with its current truth? If not, what's the rush? Let the market carry the weight of proof. Your job is simply to observe and respond once that proof appears. Once it does, the path forward feels effortless, and once you learn to wait for confirmation, your entire trading approach evolves. Your entries, your position adds, even your exits transform. You shift from reaction to awareness, from speculation to process. You stop chasing emotion and start following structures. You begin to trade reality instead of expectation. That's how consistency is born. Professionals don't act, hoping the market will validate them. They wait until the market already has. Build into clarity, not confusion. Those 5 words separate the consistent trader from the impulsive one. Every trader thinks they understand this. Few actually embody it. To most beginners, buying into weakness feels logical. After all, prices are lower. But the market isn't a store offering bargains. It's a mirror reflecting belief. You're not shopping for cheapness. You're aligning with conviction. Strength isn't something to distrust. It's confirmation that belief is flowing in one direction. Weakness isn't opportunity. It's uncertainty. When price shows strength, it means conviction outweighs doubt. Buyers are willing to pay more, sellers are exhausted, and balance shifts upward. That's when momentum becomes structure, when clear direction, controlled pullbacks, and expanding volume all converge. That's the environment professionals wait for. They don't guess at bottoms or react to dips. They add when confirmation is visible. Why force what's already flowing? Now consider the opposite. Building into weakness. What does that say about your mindset? It means you're acting against evidence, guided by emotion, not probability. You're adding to a losing trade because you want to believe it will reverse. That's not alignment. That's resistance. The market doesn't reward resistance. Every tick against you is the market saying, you're out of sync. But ego makes us argue with feedback. We double down, rationalize, and call it strategy. It's not. It's attachment disguised as logic. Professionals never average down. They scale up. They add when the market validates, not when it contradicts. Each addition is earned through confirmation, not through hope. You're allowing the market to justify your confidence, one move at a time. The first entry is always exploratory, a data point, not a declaration. Then you observe. If the market continues to respond favorably, you build gradually. Each new addition sits above the last, supported by profit and confirmation. If the trend reverses, you're minimally exposed. If it persists, your size compounds organically. That's how a consistent trader stays long enough to benefit from expansion. Have you ever noticed how the strongest trends persist far longer than logic expects? Everyone says it's overbought, yet it keeps rising. Strength perpetuates itself because belief compounds just like capital. Institutional flows don't reverse on a whim. Conviction builds momentum, and momentum sustains conviction. When you build within that energy, you're not chasing, you're synchronizing. Weakness, however, seduces the emotional trader. It whispers, buy the dip, appealing to the need to prove oneself right. But the market punishes impatience and rewards alignment. Weak assets are weak for a reason, technical, structural, or psychological. The price already reflects that truth. Fighting it only magnifies dissonance, like swimming against a current of collective conviction. This brings us full circle to emotional control. Waiting for strength requires detachment. It's uncomfortable to buy higher because your conditioning equates cheapness with safety. But in trading, safety is found in confirmation, not in price level. You're safest when aligned with momentum, because momentum is proof that you're on the right side of collective belief. Adding to a strong position isn't reckless, it's rational. You're reinforcing clarity, not emotion. That's discipline, acting from structure, not impulse. Building into strength trains patience. You don't rush because a candle flickered upward. You wait for sequence. Higher highs, higher lows, increasing volume. You let structure prove that conviction exists. Then you participate. Professionals don't aim to buy the exact bottom or sell the perfect top. They live comfortably in the middle, the space where probability, patience, and presence intersect. That's where building into strength becomes art. Now think about your own trades. How many times have you added because the stock looked cheap, only to watch it fall even lower? And how many times have you hesitated to add because it felt too high, only to see it climb without you? That hesitation is emotional conditioning masquerading as caution. The market doesn't care about your comfort zone. It rewards presence, courage grounded in evidence, not emotion. When you see strength, that's your feedback. That's your invitation to act, but only with clarity and composure. When consistent traders build into strength, they're managing two variables, probability and psychology. Each new addition is fueled by realized confidence and unrealized profit. The market is funding the trade, not their ego. Contrast that with building into weakness, which drains both capital and emotional balance. One is alignment, the other, resistance. Strength isn't just about price moving higher. It's about the quality of that movement. Is price consolidating tightly? Are closes strong and pullbacks shallow? Is volume confirming conviction? Those are footprints of participation, evidence that collective belief is flowing in one direction. When you build into that flow, you're not forcing outcomes. You're cooperating with the environment. The market becomes the current, carrying you forward. But if you add during weakness, lower highs, fading energy, expanding selling pressure, you're pushing against the current, exhausting your account and your psyche with every stroke. The best traders interpret strength as psychological harmony. They and the market are no longer in conflict. They're resonating. When the market affirms your perception, that's your signal to act. When it doesn't, that's your cue to wait. Building into strength means you respect the market's rhythm. You engage when it moves. You pause when it pauses. You no longer impose your will. You follow its tempo. Add to winners, never to losers. Simple in theory, but emotionally complex in practice. The human mind is hardwired against this principle. It seeks comfort, not truth. When a trade goes against us, we feel compelled to fix it, to prove our judgment was right. When it works in our favor, we fear losing what we've gained, so we hesitate. But consistent trading reverses this wiring. The professional doesn't rescue weakness. He reinforces confirmation. Adding to winners isn't gambling. It's executing with awareness. You begin small, test the environment, and let the market provide feedback. If the trade produces evidence, momentum, follow-through, structure, you scale in. Not impulsively, but methodically, one deliberate layer at a time. Each addition is justified by what the market shows, not what you feel. That's how consistency compounds safely. Through feedback, not fantasy. Now consider the opposite, adding to losers. This is the emotional trader's trap. You enter, the market moves against you, and instead of accepting feedback, you resist it. You rationalize. It's cheaper now. It'll bounce. But that's not logic, it's ego. You're no longer responding to data. You're reacting to discomfort. The market doesn't negotiate with attachment. Every addition to a losing trade is an attempt to impose certainty on uncertainty. And price always wins. Professionals know this instinctively. They don't argue with feedback. If the market invalidates their view, they exit. Calmly, without hesitation. They preserve both capital and clarity. They know that protecting emotional capital is the first step toward financial capital. Adding to a winner is the market's reward for patience. Avoiding losers is its protection for discipline. Have you noticed how quickly a losing trade drains not just your account, but your focus and self-trust? It's like a slow emotional leak. In contrast, a well-managed winning trade expands clarity. It reinforces the right neural pathways, the ones that associate patience, discipline, and confidence with success. Adding to winners isn't about greed, it's about reinforcement. It's how you train your subconscious to respond correctly to feedback. When I say add to winners, I don't mean chasing every uptick. I mean adding after evidence accumulates. You let the market earn your next move. You wait for the same signals. Higher supports holding, clean breakouts confirmed by conviction, structure validating strength. Each layer of size is placed so that if the environment changes, your loss is limited and your composure intact. Professionals view each ad as a new data point, a separate bet funded by prior feedback, not fresh risk. That's how you scale with the market's permission. Amateurs fear buying higher because they equate expensive with risky. But in trading, high probability often appears at high price. A rising market is a signal of imbalance. Demand is overwhelming supply. That's the evidence you want to align with. Adding there isn't chasing, it's synchronizing with momentum. Would you rather add to a position that validates your belief or one that's punishing you for it? Adding to losers is simply an emotional negotiation with pain. The mind whispering, if I just buy more, I can escape. But break-even thinking is the language of fear, not of consistency. The market doesn't reward emotional rescue attempts. It teaches through feedback, not forgiveness. The professional listens once. The amateur repeats the lesson until the account is gone. This connects directly to the earlier principle of emotional composure. It takes genuine control to add to strength, because it feels uncomfortable. Your ego whispers fear just as the evidence says go. True control means silencing that voice and trusting the data. And it takes even greater control to exit a loser without hesitation. That's why trading mastery is internal first and strategic second. Adding to winners reflects trust in the market's feedback loop. It's saying, I believe what the market is showing me more than what I wish were true. That's discipline, disguised as courage. You're stepping forward only when truth invites you. Each new layer is another brick placed on a foundation of confirmed structure. Adding to losers, by contrast, is building on emotional sand, fragile, temporary, unsustainable. Think in probabilities. A trade working in your favor has already produced evidence of alignment. Its probability of continuation is inherently higher than a trade that's proven wrong. Adding to strength means joining that momentum. Adding to weakness means fighting it. The first aligns you with collective belief. The second isolates you from it. Adding to a winning position amplifies success in controlled conditions. You're scaling exposure only when evidence supports expansion. And even when the market eventually reverses, your core profits cushion the adjustment. You built your position on confirmation, not on hope. Adding to losers does the opposite. It multiplies resistance. Every new addition deepens the attachment, blurs perception, and traps you inside the emotional narrative of it must come back. You stop seeing opportunity elsewhere because you're emotionally bonded to the losing position. You're no longer trading the market. The market is trading you. A professional's code is simple but unbreakable. Never average down, never fight weakness, never add without confirmation. These aren't tactics. They're boundaries that preserve clarity. The goal isn't perfection, it's consistency. Making the most when you're aligned and losing the least when you're not. Adding to winners accomplishes exactly that. It expands advantage while protecting focus. Every sustained trend in market history rewarded those who aligned with strength and punished those who tried to bargain with the weakness. The difference isn't talent, it's mindset. It's the willingness to act opposite to emotional conditioning, to do what feels uncomfortable because it's aligned with truth. When you learn to add only to winners, your entire trading identity evolves. You stop seeking redemption and start seeking confirmation. You stop trying to be right and start trying to trade right. Each additional layer of strength becomes a gesture of trust in process, not prediction. From that moment on, your growth as a trader becomes inevitable, not because of luck or cleverness, but because you finally surrendered to the one principle that governs all market success: alignment. Start small. Treat the first trade as a question, not a statement. That single mindset shift has preserved more accounts than any system ever invented. The difference between an amateur and a professional lies not in their tools, but in their intention. Amateurs enter with conviction. Professionals enter with curiosity. They don't tell the market what they believe. They ask the market what's true. Most traders rush in because they crave certainty. They equate conviction with courage. But conviction without confirmation is nothing more than attachment. The consistent trader begins with a test, small enough to be irrelevant if wrong, significant enough to provide feedback. If it works, the market has validated the thesis. If not, the loss is contained, the feedback absorbed, and the mind remains calm. Think of that first entry as dipping your toe in the water, not to gamble, but to observe. Is the flow with you? Is the environment stable? The professional doesn't assume. He waits, he watches, and he listens. If the structure holds, if momentum supports, he builds gradually. If volatility spikes or price contradicts, he steps aside, without resistance, without regret. Starting small preserves not just capital, but perception. It keeps your belief system flexible enough to adapt to truth.